My name is Scott Richardson, and I am President and CEO of Izale Financial Group. So before we get into the meat here, our mission at Izale Financial Group, developed and honed over the last 10 to 12 years, has been to help our clients value people. We've mainly done that through designing, implementing over 1,000 non-qualified benefit plans for executives and directors. We also help you improve earnings. Two main ways we do that are through BOLI programs. We have over $1.5 billion of in-force BOLI that we service. And we have a number, over 50 now, sustainable fee income programs that we've helped clients put in place over the last 5 or 6 years that have been a little unique for us, but very pleasant to see the results for our clients. And lastly, protecting assets, things like key person protection, succession programs, not only for officers, but perhaps shareholders of a bank, and increasingly supplemental LTD, long-term disability, and long-term care for key officers. So what an interesting time, perhaps, is the biggest understatement you're going to hear today, maybe this week. We've seen just incredible change over the last 90 days. But at the end, benefits for all employees, whether it's your rank and file or the C-suite, but for all of them, they are really now the largest, always had been one of the largest, but with interest rates being so low and deposit interest expense going down accordingly, compensation and benefits is now one of the largest expenses that you're dealing with on your P&L. And add that, we have margin compression that just got exponentially worse this year. So the challenge has been, for a lot of organizations, they're cutting forecasts. You know, I serve on the board of directors of a bank, and we're challenged with the same issues that you're dealing with. And those cuts and reductions in what we think we're going to earn aren't just for 2020, they go well into 2021 as well. So the question becomes, where can you find earnings to help offset this increasing benefit expense side, and at what risk does that come with? And if you look at the markets, it's been kind of a pretty good ride. You know, we've seen on a percentage basis a 90% drop in Fed funds and short-term treasuries, 60 to 80% drop in the corresponding 10-year treasuries. And of course, if you're trying to do things in the market, S&P at one point was down 30% for the year. It's back up from that low to where at the end of June anyway, it was down a mere 3.5% for the year, 3.75%. So it's tough to find earnings when you see those things sort of come down. As you look at the universe for what you can do to offset benefits, whether it's, again, broad-based or narrow from an executive's perspective, BOLI, bank-owned or business-owned life insurance for a credit union, is the only asset out there that allows you to have some greater return potential, at least relative to the traditional investment portfolio. Gives you the opportunity to enhance benefit designs that you have, whether it's stronger contractual promises in a SERP agreement or supplemental life insurance, you can enhance programs. It's life insurance. There's ultimate gain if held to maturity that recovers the cost of all the benefits that you're paying out. And in these turbulent times, the idea of a guaranteed minimum interest rate is attractive. We know where the floor is, but at the same time, it has guaranteed book value. So interest rates rises, at some point they have to rise, we hope. But when interest rates rise, the general negative effect that has on your fixed income investment portfolio does not apply to BOLI. No mark-to-market risk in BOLI, at least general account BOLI, as we're mainly talking about here today. And by the way, the little footnote at the bottom, we don't talk about this often enough, but in the bank world, they've had regulatory guidance out for 15 or more years that says a bank is permitted to invest in equity-like assets only if there's a direct, sort of a perfect hedge to deferred compensation and executive benefit, whose liability balance sort of moves up and down. The theory on the bank side is they want no impact on bank capital. Assets move up 20%, down 10%. Liabilities do the same thing. No change to equity. We don't have that such hard rule with the NCUA and credit unions. They've put it in their examination manual that equities are only appropriate when these things but there's not as much teeth or bite behind that in the examination manual as there is in a formal guidance that you see in the regulatory side. I sense that that's coming though, so keep that in mind. If you've looked at BOLI before, if you haven't, if you've never heard of it, understand that the trail that's ahead of you is it's a pretty well-worn one. BOLI has been used by banks since 1982. And at the end of March, we had just under actually 65% of all banks of all sizes have BOLI to the tune of $178 billion. And if you take out the small banks, those that are say under 300 million in assets, that percentage use jumps up to 77, almost 78% of banks. So again, very well established, adopted strategy there. A little different on the credit union side for a number of reasons. Interesting, there's about the same number of institutions, but the usage there is only 16% at about 6.2 billion. Take out the smaller ones, a lot of small credit unions, take out those under 100 million, and now the usage jumps up to 40. The reason credit unions are behind are twofold. One is, well, three. One is their regulatory permission came much later. So the banks, again, have been doing it since the 80s, credit union much later. Number two, the tax-exempt nature of a credit union, there's a certain tax advantage to having BOLI that you just don't have with a credit union. So in higher interest rate environments and those things, it may not be as attractive as other assets on the balance sheet, but right now it's very powerful. And third is carriers. We'll talk about what that means in a couple of slides, but some of the carriers that are consistently in this space are frankly fearful of tax-exempt organizations that we'll talk about later. So what BOLI is not, and we run into so many organizations where this is married in their minds, BOLI in and of itself is not an executive benefit. At the end of the day, it's just an asset that you can own that's an alternative to your investment portfolio. And that's the way really it always has been. Yes, there are features of BOLI that can help you enhance the benefits. That's the life insurance things. The compounding earnings, the growing cash surrender value of BOLI certainly matches well with the expense of executive benefits, but there are two unique decisions, buying the asset and offering the executive benefit. Again, it gives you diversification to the investment portfolio. And I say it's not an either or decision because no one should be advocating, and we certainly don't, that you abandon your traditional investment portfolio. There are attributes of the portfolio that you want to have. There are attributes of BOLI that are attractive to have, and they're not either or. You can and should do both. What the regulators have said a long time ago and continue to say is that you do have to justify your rationale for buying BOLI as an offset to employee benefits. And I think that's where the tie comes in, that in and of itself it's a benefit sometimes, but it's just a sort of a bucket approach. So all of the employee benefits that you offer as an employer, health insurance, your share of the expense anyway, the 401k match, safe harbor contributions, profit sharing, pension plans, deferred compensation, all of those benefit expenses go into a bucket. And that becomes your rationale to buy an asset like BOLI. You can't put in things like salary, bonus, unemployment insurance, workers' comp premiums. Those things do not go in there. The thought process, or Social Security, the payroll taxes and those things, the thought behind those is you have to pay those things just as an employer. You don't have to offer health insurance, 401k, et cetera. So the voluntary type benefits that you bring in become the pay for. And lastly, regardless of how attractive it may be as an asset to own, there is a limit. It can be too much of a good thing, I guess. And if you've been in banking long enough, you'll understand where these come from. The regulators want you to evaluate or think of making a loan to an insurance company. And so in the context of making a loan, they have an aggregate concentration of credit issue, and that's historically been 25% of your capital. When you look at the leverage ratios and whatnot, we're talking at most 2%, usually 1.5% or so of total assets is what we typically talk about in this asset class. There's a per carrier limit we'll talk about a little later on, but concentration of credit is the source for that 25%, and that's now spilled over into the credit union world. Well, given all the different investment options that you have out there, what is so unique and attractive about an insurance company's balance sheet? And there are 4 things. One, you have superior credit risk. Obviously, if you're buying only U.S. Treasuries, you can't get any greater credit risk than that from a pure risk perspective. But in this scenario, we're talking about insurance companies. Those that are consistently in this space are multi-billion dollars in terms of assets, 50, 60, 100 million in assets or more, and they have extremely strong capital. They have to. BOLI is capital intensive for an insurance company to offer. In your world, it'd be like making a loan that had a risk-based capital charge of 150%. You're going to do it with the right circumstances, but you don't want to do too much of it because obviously it depletes your capital. Same concept here. Carriers that don't have strong capital positions just aren't in the BOLI space. Another big reason is diversification. Insurance companies have spent decades building up a very broad-based portfolio. They manage their liabilities accordingly to their particular needs, or their assets, to their liabilities. So they have this portfolio that is just more diversified than you can typically put on your own balance sheet. And of course, diversification reduces risk. Duration. Third benefit of here is durations. Carriers, as I said, do ALM matching, if you will, just like you do, except their liabilities go 20, 30, 40 years. And so they're routinely buying assets that go 20, 30, 40 years in duration. They're not selling assets for gains on a routine basis. They are buy and hold creatures, and they match it up accordingly. They don't use GAAP. They use a different statutory accounting framework that kind of makes that a little different. So the result is the average duration that we see in the carriers offering BOLI is 6 to 10 years, maybe even 11 years in some other times. And typical yield curve, further out you go in duration, you should be rewarded with that to get greater return. Now, if I stopped right there, every organization listening to this call could extend their own portfolio. If your bank or your credit union is 1 to 2, 1 to 3 years, you could go out and buy a bunch of 10 or 20-year assets. There's nothing to prevent you from doing that, except for this other issue, and that's mark-to-market accounting. If you own an asset, a fixed income asset, directly on your balance sheet, and interest rates rise, you're going to have a loss in value, and those now have to be run through the earnings statement. A lot of organizations saw the gains when we saw rates rapidly fall in March in response to coronavirus. And so what giveth taketh kinds of things, and it creates an earnings volatility that isn't always attractive. Well, within BOLI, the insurance companies, again, the statutory accounting framework, they don't have those wild swings in the mark-to-market exposure. So you have a pretty predictable, kind of boring asset to work with. And if there's a fifth one on here. If you're a bank or any tax-paying organization, you wrap that into a tax advantage vehicle. So the question becomes, how do you get invested into that insurance company's balance sheet most efficiently, the quickest you possibly can? Because all of those criteria, by the way, those 4 or 5 different bullet points are available to us as individuals, but we don't have the luxury as an institution to get in quickly. So here's what BOLI is not. It's not the policy that you and I would buy as individuals. In fact, they won't even sell it to an individual. So here, our objective on your balance sheet, a bank or credit union, is to maximize what you can earn on the premium you pay, or to cash value performance. So routinely, it's typically a single deposit, a single premium structure, where your cash surrender value is equal to the premium you pay on the first day. And our second objective, because it's life insurance, we have to have some element of life insurance, but we really want that to be as little as possible and still qualify as life insurance under the tax code. So think about how you might purchase it. It might be flipped around. You want the maximum amount of insurance for the premium that you're going to pay. Here, it's just the opposite. And again, 100% surrender value from the first day is the typical BOLI contract. There are sometimes you'll hear something called BOLI that has a first-year load. That's typically a more of a retail-like product that might have been just high early cash value, but it's not the same thing. So 100% surrender value from first day is the key here. And you get interest credits on that premium, on that cash surrender value, and you get charged monthly the cost of insurance based upon the amount of death benefit that's there. So the lower that death benefit, having that as little or as low as possible, means that our monthly mortality costs are therefore low and not dragging down performance. Here's sort of a graphic way what that might look like over a 25, 30-year period. So the dark blue here, let's assume you started with a $6 million investment, for example. Well, that's your day one cash surrender value, and that's your basis. And that becomes, I'd say, principal protection from market risk. Interest rates could spike 150 basis points in August. They went down 150 in March. I suppose it's possible to go the other way. But that would not have any impact on that $6 million basis. No market risk. What you really want as an institution, though, is this growth in cash surrender value. And every month, you're going to accrue that growth as other non-interest income on your income statement and balance sheet. And like clockwork, the insurance company reports the new cash surrender value, and you report the change. And the only thing that really changes from year to year is the pace of change. So the interest rate, we know there's a minimum, whatever the maximum, or there's no maximum, it's what the carrier, will charge based upon the current rate environment. And then lastly, you do have, again, it's life insurance. You have this gain amount, and it's this sort of off-balance sheet benefit that you have the opportunity to do different things with. If you'll notice the graph, the gain amount in these scenarios is the highest in the first year or two. And then as cash surrender value grows, here, you'll see that the gain amount grows, but less at a slower pace, and so it actually squeezes down. And if I were to extend this chart out to to its natural maturity, you would see cash surrender value equal the life insurance benefit. Therefore, there would be zero gain at that point in time. Typically, that's age 95 or age 100. So again, very efficient to grow cash surrender value. It's one of the worst ways to deliver permanent post-termination life insurance benefit. Pre-termination, lots of cool things you can do we'll talk about. When we look back over the last 10 years, this gives us an idea of why BOLI has been attractive, and we see what the typical alternative investments have been, with the 2-year, 5-year treasuries, even mortgages and bonds. The heavy line is what we've seen in terms of BOLI crediting rates and returns over that time frame, and they have consistently outperformed investment portfolios. From the regulator's perspective, you do have to consider the guidance that they put out there. And I'm going to start with the banking side of it. So OCC Bulletin 04-56, it's actually an interagency statement. It's Financial Institutions Letter 12704, I believe. And that actually was 14 years old, 16 years old now. It's the 4th iteration of formal guidance that the regulators put out. I was fortunate to be in a company back then that I had pretty considerable input in helping them get to the point in drafting that and releasing it, so I'm quite familiar with it. That hasn't been changed again since late 2004, but what has happened is, the NCUA had this rule 701.19, which gives credit unions permission to buy these kinds of assets, and this is really the unofficial NCUA guidance. They do reference it specifically in their examination manual. Again, examination manuals don't have the force of formal bulletins and other guidance, but you'd be best to understand how they're looking at it and what they're expecting from you. So within this thing, they have it's a 28-page document. It's not terribly long, but they lay out a clear roadmap of what you should be doing before you buy things. How should you analyze it? What are the categories of risk and whatnot? And then lastly, you don't buy this and stick it on a shelf. You do need to watch it. And so they have a again, a process for the post-purchase monitoring as well. And the phrase policies and procedures is peppered throughout this OCC bulletin. And whenever the regulators, throw that around as frequently as they do in here, they're kind of telling you that you should have a policy and a procedure. They love policies, loan policies, vendor policies, vacation policies, pandemic policies. So have a policy relating to this kind of an asset class, and you should. And in here is where they talk about those limits. So again, we already talked about the 25% sort of aggregate limit, and these are all relative to capital or net worth. But they also have a second limit in exposure to any single insurance company, and that's 15%. So in the lending world, that's the FDIC's legal lending limit, 15% of capital. That's how that came into play. So even if you didn't have these limits, there's a prudence to diversification anyway, in terms of limiting exposure and whatnot. But just keep those in mind. You can have too much a good thing if you're not careful. By the way, the 25% limit is in most places a soft cap. So if you think about BOLI as an asset, and let's say it grows every year at 3%, and you have a year where your net worth or capital doesn't grow because earnings are flat or you paid a big dividend, whatever the case may be, it's not uncommon to see institutions who utilize this to this fullest extent to be at 26, 27, 30, 35% of net worth. And as long as you're doing the things that you're supposed to be doing to monitor this on an ongoing basis, regulators generally won't criticize you. They'll mention it in a report, but they're not going to criticize you for not paying attention to it. The 15% per carrier limit, the exposure there, our experience is they draw a line in the sand on that, and they are much more concerned about your exceeding that limit. And we've seen a couple of instances over the years where an institution has been told you have X amount of time to deal with this, and you surrender some of it. Tax consequences be darned if you're a bank. So be mindful of that. You probably, if you're considering BOLI, make sure your per carrier exposure probably stays around 13.5% to give you some room for that to grow in 1 or 2 or a few years where capital may not. Accounting is fairly clear. There is an ASC codification out there, but in this case, again, beginning cash surrender value equals the premium paid. We are aware, and we've sold the products that have an expense in the first few years, but those are not the typical BOLI thing, and those should be very clearly disclosed with no surprises. Growth, the monthly change in cash surrender value, accrues as other non-interest income. And again, it's ASC 32530 that deals with investments and insurance contracts. And I get this question frequently, but note, there is no cash flow with BOLI, right? It's accrued earnings. It's real in the sense that the insurance company tells you your value is greater this month than it was last, but you accrue it. The only time you turn that into cash flow is when you either request a policy surrender or some other distribution from the policy, or there's a maturity, event, death of one of the insureds. You do have to put this on your call reports. So for a bank, it's going to go on your schedule RCF, other assets, line 5. And there are, an A, B, and C to that line 5 that's beyond the discussion for today, but generally line 5. And for a credit union, it goes on your schedule B, line 20. And if you're a credit union, note that line 20 not only deals with BOLI, it deals for other types of investments, split dollar loan. Those all go into there, and that limit, that 25% limit, generally applies to that bucket that you see on line 20. So you can't do 25% in BOLI, 25% in split dollar, et cetera, those kinds of things. And good note for anyone who's a state chartered credit union or for all banks, for any policy issued after August 17th of 2006, there's an annual reporting requirement with your tax returns. And it's Form 8925, and it's just informational only. And so you just attach it to your tax returns and you're done. So if you do a Form 990, again, for state chartered credit unions, it needs to be attached there too. So there's an exception for policies issued before that date in 2006. They're grandfathered. However, if you do an exchange, you generally lose that grandfathering. So be mindful of that reporting requirement. There aren't really any penalties for not complying with it, but you don't want to get the IRS busy and looking at other things too. So just easy to comply with. So you've looked at this, you've evaluated it, and you decide that you want to put it in place. How do you do it? Well, one, this is something that requires board approval. If not every time, certainly the first time. So you've got an investment policy. It is highly unlikely that it's covering any purchase of BOLI because it's not a traditional investment. Doesn't fall under that policy. So again, adopt a separate BOLI policy statement, maybe even a supplement to your existing investment policy, but have a specific separate statement. Again, you can take this to the board and have the board approve the policy, which allows management to implement it down the road. Within that policy, again, following best practices and even the suggestions, very firm suggestion from the regulators, put in limits. How much are you going to have per carrier? How much are you going to have in the aggregate? Doesn't have to be as high as what the regulator said. We've got a couple of clients who adopt a lower internal threshold. Put in guidelines for how you choose a carrier, when you're going to keep a carrier. Usually those are around ratings, their capital, their commitment to the industry, and those kinds of things. So I would avoid using ratings only because that's a fairly weak measurement of how strong a carrier is, frankly. We've got a turnkey BOLI policy statement. First drafted it back in January, February of 2005, and it has since become really used by most of the industry. So feel good about that. Obviously, if there are associated benefit plans, again, they're not always the same, but you might do a SERP benefit. You might do a supplemental life insurance benefit, those kinds of things. Those are contracts between the institution, the bank and the credit union, and the participants. And often a participant is the CEO. And so I think that these plans should always be reviewed and approved by the board, even if the CEO has people below him or her that are participating and report just to the CEO. Again, we do signature ready documents. We've been doing this a long time. We never want to replace your outside counsel, but we can make that process way more efficient, less costly than having it drafted from scratch. So in the, again, there are, 750, 800 different life and health insurance companies remaining. There are only 7 to 10 of them that are consistently, actively selling a product to banks. And only 3 to 4, 5, depending upon how you measure the fifth one, is actually offering that same design, that same product to a credit union. And the reason is disintermediation risk. We'll talk about that in a second. The distribution of these, I didn't create this phrase. I got it from somebody else, the certified BOLI advisors. The carriers have fairly limited distribution. So among, we might have 100 people across the country at 8 or 9 firms like Isael distributing BOLI. When you look at a carrier, obviously their particular risk profile is important, but also the product. And the product in terms of how interest rate is credited, what kind of guarantees there are, those kinds of things, and each one is a little bit different. So when it comes to crediting rate, you want to know, is it a fixed rate, that the carrier declares each year, each quarter, or is it an indexed rate that's somewhat transparent but measured to an external index that everyone can sort of track on their own. You also want to know, especially for the fixed rate things, this only applies to fixed rate, how is the carrier setting that interest rate? Is it based upon a broad portfolio or what they can earn today with new money they're investing and reinvesting today? Totally different approach. So you have the ability to dial in, if you will, your initial yield by choosing, by allocating among the carriers and the different products that they have. Back to the interest. So there's 2 different concepts here for a fixed rate product. We have traditional whole life, and there's only 1 carrier remaining who has a 100% surrender value product in that space anymore in the whole life basis. Everything else has become universal life. And so with universal life, again, the crediting rate is declared by the carrier. They know they need to remain competitive in the space, or they're not going to get new business. They may lose in-force business. So there's a little bit of a motivation there, pretty strong one actually. And the question becomes is how they look at the assets that they have. And it's either new money, which is based upon a current environment, or portfolio money, which is a seasoned, much longer, broader book. All of these products have a guaranteed minimum gross rate before the cost of insurance charges of 1 to 4%. Or is the whole life structure a fairly large drag in cost of insurance, but pretty high good crediting rate. Remember that the insurance company's portfolio, whether it's a 5 or 6 year on the shorter end to 10 year on the longer end, it can't move as quickly as market rates do. It takes time to capture the swings in market rates as new premium comes in to get invested, older assets mature to get reinvested, those kinds of things. So the crediting rate on these products always lags what the general market is going to do. So if interest rates are generally coming down, BOLI will come down as well, just more slowly. Same thing when interest rates rise back up. So rapid changes in market rate environments kind of distort the value of BOLI, whether those rapid changes are up or down. But just remember, crediting rates are going to lag. There's not a lot of volatility from year to year. And unlike the fixed income portfolio, can't reiterate this often enough, is the mark-to-market risk is a nice trade-off for that lagging rate. So I always say BOLI is kind of boring. It's conservative. It's fairly predictable, or at least the universal life is, from year to year. The other approach, and this is fairly new, and I say fairly new, the strategy's been around for 20 plus years in the retail side, but only the last 3 to 4 on the institutional side, if you will. And that's indexed universal life. So this is where the crediting rate, and it's crediting rate only, is measured based upon the change in some index. Most commonly used is the S&P 500. So cash surrender values still have the 100% book value treatment and backing of the insurance company. They are not exposed to the S&P. So if the S&P went down 30% earlier this year, not a dime was lost in cash surrender value of index UL. Again, it's a measuring tool only that doesn't give you mark-to-market risk. So typically, you look at the simple change in the S&P 500, and if the change over the prior 12 months, so for example, every month, today's the 16th, we're going to say, hey, we're going to measure this on the 16th of every month. What is the 1 year change in the S&P? If it's 0% or lower, sometimes you see a floor of 1%, but generally that's your minimum, then your crediting rate is 0. So S&P is down 4% for the year, you're not going to get a negative 4% crediting rate, you're going to get 0. On the other end of that spectrum is if we have a 10, 20, 50% return in the S&P, you're not going to get the full return. There's a cap, 8.5% right now. There's a couple of carriers that are a little lower, but you get a smaller corridor of potential returns. What we've seen over the last 10, 12 years is when we compare real life S&P returns with product features, that it would have outperformed the traditional BOLI approach by about 1%, like a little bit over, almost 1.2% every year on average. Not every year, but on average. Here's the limitation to it, though. Really tough to budget, right? Because we don't know what the S&P is going to do, and we don't measure it until it's over. So your budget purposes, you're going to put in 0% return for that little piece that's in an index, and then adjust it accordingly. And that's not always easy for boards or even for CFOs to kind of get comfortable with. So it's rarely the sole asset in a BOLI program, but it may be one part of a larger portfolio, can be very attractive. For credit unions, we're actually seeing a lot of interest in this in those that have charitable donation accounts, because they can use the positive returns, let the BOLI, the index BOLI, make the charitable contributions or distributions. Otherwise, they'll go to earnings if they're going to do anything. It is life insurance, so we have to do something relative to underwriting. And there are sort of three approaches. It really comes down to two, but one is regular issue. If you've ever purchased insurance on your own life, and I hope everybody listening has, you know the drill. You got to do a full medical history through an application, medical exam. You may give blood, you may give urine, depending upon your age and how much. You might be doing other tests like an EKG. They'll ask for doctor's records where there's been some history, those kinds of things. When you've got a very specific death benefit need on somebody and it's high, or you've only got a few individuals, 3, 4, 5, 6 individuals, this is your only option, and you've got to do this. Because the insurance company is looking more thoroughly at the risk, obviously you can have a much higher death benefit on any particular person. It depends upon what the underwriter feels like that particular day, I guess. Regular issue, 60 days is not uncommon. Sometimes we're seeing a little longer just because of COVID is dragging things out a little bit, but generally it's 2 months from the time you say go. And because that insurance company is doing a more thorough analysis of the risk, you generally have a higher yield. Can be as much as 15 to 20 basis points higher than some of these alternatives we'll talk about. Where we have less than 10, but there's a good solid group, 4, 5, 6, most of the time it's a minimum of 5 executives, we can try to do what's called simplified issue. We're going to do the full medical history, but we're not going to ask for an exam. So no blood, no urine, no parent, no nurse coming to do those kinds of things. And then doctor's records will be requested for cause. And in the event that somebody has a unique issue, insurance company reserves the right to push that person back onto what we call the regular issue track, and all of a sudden you're back into full underwriting. So in 20 plus years of doing this in the institutional space, I have never had a simplified issue stay completely simplified issue from start to finish. So we really don't talk about it too much because likelihood doesn't matter. So regular issue is one. Guaranteed issue is an option for a lot of organizations. And here we need to have a group of at least 10 employees, 10 officers who meet an objective group definition. An objective here is, well, we'll get in a second, is anybody can sort of come up with the same 10, 12 people, however you want to do it. So minimum of at least 10. This is, you're interplaying the insurance company's requirements of 10 with a tax code section 101J that says employers, and for the moment credit unions are caught up in this analysis, that employers only get the tax benefits of BOLI if they insure the top 35% of all of employees. Well, if you take 10, the carrier's minimum, and divide it by 0.35%, which comes out of the tax code, you get 29 employees. So the moment you have 29 employees, you've now grown large enough that you can consider guaranteed issue. So this group definition, this objective group definition, the carrier wants to understand how they're doing it. It'll be very clear in a second why, but they're worried about adverse selection. How much death benefit that you can get on any individual person is a function of how many people. So there's a factor, and you multiply the factor times the number of employees. So 10 is one number. If you go to 11 or 12 or 15, it exponentially grows. So how much you can purchase with an insurance company is driven by how big your group is. But there are no invasive tests or questions. They do not even ask you what your height and weight is. There are 3 questions that are asked on a 1-page consent form. First one we already know the answer to. Have you been employed by this bank or this credit union for 90 days? Yes or no? If the answer is no, they just want to know were you actively employed elsewhere prior to your start date here. Second question is what we call the knockout question. And it's during the last 90 days. It's only the look back we have is 90 days. Have you been hospitalized? Or have you been out of work for 3 or more consecutive days due to illness or injury? Again, if the answer is yes, they want a little bit more detail to include you in the group. If it's I had my knee replaced, even if it's I was out with COVID for a week, they're not going to exclude you. They will exclude you if you say, yeah, every 6 weeks I go get chemo on my gallbladder. They want to exclude that kind of risk. But again, very easy to implement from start to finish. If the board says go today, we can be done in 7 to 10 days. So we get about a 2-month head start over regular issue, in the full underwriting process. So where we see clients and prospects with the opportunity to do guaranteed issue, they gravitate towards that. The ease of implementation and the lack of invasiveness is the driving factor there. Question always comes up is, okay, we have this insurance policy. Remember that green amount on that prior graph, that life insurance gain? Well, does the insured employee get a benefit? Well, they can. And all but 3 of our clients offer some form of supplemental life benefit. And that's going to go to 2 here in shortly after talking with one earlier today. But all of them, in that sense, nearly all of them offer a supplemental life benefit. And it comes solely out of the gain that's available in the insurance policy. So it never goes into the cash surrender value. So your balance sheet will never be impaired. And it's typically written so that, again, they only designate a piece of their thing when they're actively employed. So if they terminate for any reason, that benefit ends just like group term life insurance would. Or, of course, if you decided to surrender your BOLI or not be in that asset class anymore, you don't want to be obligated to give something that you don't have anymore. So when this is done, understand it doesn't result in any additional out-of-pocket cost to your institution. You've already purchased the insurance. It's not like group term life where you have to continue paying a monthly premium. So offering this doesn't cost anything. At most, it's foregone gain. You have a decision whether you want to make that an income tax-free benefit for beneficiaries or let beneficiaries pay income tax on that. And the difference is how you, whether you report a little bit of imputed income to that insured executive or officer while they're actively employed. And it's peanuts relative to the tax savings. So more clients are trying to do a tax-free approach. The administration is fairly simple. How much you share is all over the board. We have clients who will do a flat amount, 10,000, 25, 50,000, et cetera. Others who will do a multiple of salary, 1 times, 2 times, and yet others who will do a percentage of that net amount of risk. They might do half of it. Half is yours, half is ours for key person protection. There's no one right answer there. It's just going to be one that fits for what you're trying to do. And you can do different things. Remember, if I have 10, 15, 20 employees, I don't have to do the same benefit for all of them. I can do the C-suite at one higher level, VP suite at a little lower level, et cetera. You can get creative, and HR likes those kinds of things. Again, most of the time it's pre-termination only. It's pretty rare. It used to be more common, but these days it's pretty rare to see much in a post-termination, whether it's following retirement or otherwise, for 2 reasons. One, accounting rules came into effect in 2008 that sort of required a little bit of a modest accrual. That's more of a hassle than anything else, but it's an expense where you don't need to have one. But more importantly, remember, BOLI is really inefficient at providing death benefit. It's really efficient at providing cash surrender value growth. So if permanent post-retirement or post-termination life insurance is desirable, there are better ways to do it. So as we come close to the end here, what has changed and rapidly changed? Again, 33 years in this business, 20 focusing on financial institutions, and it's sort of breathtaking here. And again, I'm not talking, I'm preaching to the choir on that. What we've seen, Fed drops rates 150 basis points, the whole market responds. That impacts your margins, it impacts the insurance company's margins all across the board. So we've seen some carriers limit new sales. Some have said, hey, we only want to take premium from existing clients. We don't want new clients. Others have said, we only want a maximum case size, no more than 5 million, 10 million, 15 million of premium from any purchaser, new or existing. Others have said, we're going to have a total capacity for the rest of this year. Remember, BOLI is capital intensive for the insurance company. So it's like writing those 150% risk-based loans. You've got to, it ties up more of your capital. So they're mindful of that, and they just limited their capacity. They're managing capital very carefully. All of them have reduced crediting rates from the low end of 10 basis points, 0.1%, all the way to a full percentage point in response to all this. Despite all, and we even had one who just pulled out of the market for the rest of the year and said, we've got a product that's just not sustainable. It had a really high guaranteed interest rate, relatively speaking, and they pulled the product. It's been repriced and they're waiting for the time, better time to get back into the market. But that'll be, I'm guessing, January of 21. Despite all that, interesting enough, sales have gotten stronger over the last 30 to 45 days. We've seen obviously with deposits way up and loan demand sort of tempered out. We've got a lot of institutions with a tremendous amount of liquidity. I'm not convinced that you should always be taking that and put it into BOLI, because remember, that liquidity that you have right now may not stick around as the economy opens back up, as rates ultimately temper things, people spend money again. BOLI is a long-term asset. It looks really good from a liquidity perspective, but this is that 1.5–2% of your balance sheet that you're not really going to need to redeploy into the loan portfolio, maybe ever. So good, strong earning asset, but keep that in mind. And I do see that there's one question in there. If you would be patient, I'm going to grab that in the second here, before we wrap up. Bottom line, you know what? Let me ask that question now. I'm going to see if somebody, have you seen a trend in BOLI policyholders, and this is really bank specific versus credit union, shifting more towards supplemental benefits as opposed to separate account BOLI? So separate account BOLI is one variant that is beyond much of a discussion for today, but instead of having your cash surrender value just invested into the insurance company's general account with all their other assets, there's a separate fund, separate account that you get to allocate. So it could be a mortgage-backed securities fund. It could be a government securities fund. They're typically bank eligible investments already, but the theory being that you can pick a fund manager who might be give you a little bit of alpha based upon return, a little bit more transparency in those things. We just haven't seen a whole lot of separate accounts sold in the last few years. There's mark-to-market exposure, obviously, when you have the separate account assets, and the mechanisms to minimize that exposure through stable value wrappers have either just gone away because providers didn't want to provide them, or they've gotten expensive. So the yields in separate account aren't all that greater today than general account, and I think some people are mindful of that. So could it come back in a few years as we see interest rates rise and markets be somewhat normal? Perhaps. So I haven't seen, again, a trend to separate account yet. I'm not sure if that adequately answered your question. If it didn't, please ask it again. Bottom line, as we wrap up here, BOLI remains a very attractive asset to own. It's multifaceted. It can give your bank or your credit union a very strong competitive yield, still in the high 2s, low 3s, without mark-to-market risk. Obviously, continue to offset your benefits that you're still providing all your employees. When you look at both banks and credit unions, we've got more than 4,000 of them have done this. So the asset's it's a well-worn path. It's been vetted. If you don't have it, if you're not sure of it, don't follow what 4,000 of people doing blindly, of course, but be properly inquisitive, and understand that if your peers have found that there must be something there. You just got to find out if that fits with your particular bank's objectives. So be inquisitive, but not intimidated. Lastly, work with somebody, a vendor like Isaiah, who has experience in the design, all the related benefit plans, has multiple carriers that they can bring to the table. Again, remember, we've got template board materials. I serve as a director of a community bank, so I understand when I sit in that seat what I'm supposed to be doing, and we try to deliver that message and to deliver those things accordingly. We simplify the process significantly for that. We also do a fairly comprehensive due diligence package at the end, so it makes it easier for you to excuse me, deal with an examination, an audit, internal staff who needs to manage a program and whatnot. And this sounds exhausting, by the way, when you think about this due diligence process, and it can be weeks, sometimes months of analysis, but your time might only be 4, 5, 6, or 8 hours in the aggregate, spread out over that time frame. We do a lot more behind the scenes in terms of modeling and proposals and preparing, but the actual time that our clients spent based upon what they've told us might be 6 to 8 hours, and again, spread out. So don't let the idea of doing something and trying to comply with the regulatory requirements scare you away. It's not that complicated. Again, our experience and expertise, when I look at all the associates of the firm, we've got over 100 years just in financial institution space. We've done over 1,100 actually, helped had our hands on, if you will, gotten dirty in over 1,100 non-qualified benefit plans over the last 20 years, $1.5 billion of BOLI sold. Our interaction with state and federal regulators goes back quite a few years, continues. And frankly, we solve problems and fix prior mistakes that we run into all the time. I'll end with a quote that a CPA put without request or an ask on LinkedIn a few years ago. Extremely humbling. Still work with them quite closely. And again, you'll see this slide deck when we're all done here. So turnkey support, it's pre-purchase analysis, the board materials, the due diligence we talked about, the benefit plans, our post-purchase servicing. We've got a secure on-demand website that's at your fingertips. It gets updated every month. So it ensures that you get timely and accurate reports for your own financials, benefit statements where benefits are associated with it, and just as importantly, an annual risk assessment. So we come back every year and revisit down to the granular policy level what you have, reproject it, look for weaknesses or any changes, because things can change. Carriers can change, you as an institution can change, and you always want to make sure this remains viable and relevant. So as we wrap up, thank you for your time today. We will send out the slide deck when we're all done to those who participated. And again, it will be posted on our website for listening later on for those colleagues of yours who weren't able to listen in. Have a great day. Thank you.